What is going on, guys? So obviously, if you guys are paying attention to the market today, Apple and along with the majority of other tech stocks are continuing to sell off today, and a lot of that has to do with, improper guidance, a lot of people freaking out about still about the Apple's earnings, and just a couple of other big headwinds and people, just kind of pricing that immediately into stocks. And I'm just going to be kind of walking through, what's going on with Apple and their suppliers, and then a couple of the key stocks that I cover here on the channel. Now, I'm only focusing really on these stocks that I cover here in the channel today because I think they are directly, getting affected by what's going on with Apple, and they're the stocks that I, have been following for quite a while, and I think I can kind of figure out what the market's doing, at least in relation to how they're pricing it into the stock. So if there are any other companies that you guys want me to look into that say are getting beaten down over the past couple of days, just let me know. Throw it down in the comment section down below. Any stock that you guys want to talk about, we can just open up a discussion. I try to reply to pretty much everybody down in the comment section below. So without further ado, let's jump into the video. And so obviously at the top of the list right now is Apple and their suppliers. Now I've been reading a few articles today and over the past week about why people are freaking out about Apple, and honestly it boils down to a couple of metrics. The most important one I'm seeing is that analysts are really hyping the weak iPhone sales in the future. Their guidance is relatively low. Apple already talked about, removing this number from their future earnings reports, which immediately, had a lot of backlash from investors because, if you think about it, investors are part owners of the company. So if you're hiding something from the owners, that doesn't go over well. I kind of understand where Apple is coming from. I do think it's a bit, distasteful to do it as the numbers start to go down as opposed to while they're going up. I think it would have been handled a little bit differently. But I completely understand why Apple is doing this, because they say that, okay, well, we're beating revenue, we're beating on estimates, we're beating everything as a whole, but because everybody is just kind of looking at the iPhone is what is going to, make or break Apple in the future, Apple's kind of getting fed up with it, and obviously the stock is getting fed up with it. So that's kind of the biggest headwind with what's going on right now. And then also a lot of Apple's suppliers, so like you look at Skyworks, the people that do their facial recognition, and just other semiconductor companies in general are projecting lower guidance because of the weakening iPhone sales. And that is just kind of a secular trend, and also just kind of, when you think about it, iPhones and just other smartphones in general have been exploding the past couple of years. Odds are a lot of people, if the tech isn't like super innovative, they're not going to really, shell out another $1,000 to upgrade their phone each year unless it's worth that money. You can get it. And there's been no real innovation this past line of phones. So, you can kind of look at the TikTok cycle of, like, say, semiconductors that mainly relates to Intel. And like a couple of years, you're going to have brand new tech. Other years, you're going to have refined tech that's going to blow customers' minds. So we're just kind of on the weak end of it. People are focusing more so on, the software-related things instead of the big, hype changes in tech and hardware. So we're just kind of in a weak market right now. But the market right now does not think that Apple is going to be growing anywhere near the rate that it has in the past, and that this is the beginning of the end for Apple, so they're pricing that into the stock. Going down to Micron. So Micron is kind of wrapped up in all of this. I do think that Micron is relatively resistant to this issue due to the fact that they get most of their memory, they sell most of their memory through data centers, but because of the whole issue with Intel, we have known for a while now that Micron is going to have a slow couple of quarters. This is just kind of pulling it down along with it. Now, Micron does supply the RAM to the latest generation of iPhones, but they do not supply the RAM every single generation of iPhone. So this shouldn't realistically be that big of a news headwind for Micron, in my opinion, because Micron isn't counting on that recurring revenue because Apple is relatively, stingy on who they pick their semiconductors from each year. So it was nice that Micron got this bump, but it's not like every single year they buy from Micron. So I get and I don't get exactly why people are assuming Micron is going to be suffering because of this. But Micron is in a bear market. Everybody thinks that the DRAM issue, we're in an oversupplied state because of issues that aren't because of oversupply. If you guys have obviously been paying attention to any of the DRAM manufacturers. But Micron is currently, just in a bear market, so any bad news will immediately pull down the stock with the rest of the semiconductor space and pummel it down more. It's relatively resistant compared to what a lot of the other suppliers for Apple are doing, but because it's already been discounted so much. But again, a lot of people are saying that, okay, we're in an oversupply rate for DRAM, but then you relate that back to prior to last earnings, and we were in a under demand, like we had much more demand than we had supply, but everything got held up because of the Intel fiasco, and that Intel isn't pumping out new chips for data centers until the second half of 2019. And a lot of people haven't really switched to AMD because they haven't had, enough reassurance with their platform yet to really justify switching over from Intel to AMD, as we saw through AMD's earnings, which was kind of alluded to in Micron's earnings. I made a comment of it that AMD was going to have a relatively lackluster quarter because, if the companies that were waiting on a new CPU to buy Micron's chips couldn't get the new CPUs, that means obviously they didn't get them from AMD. So obviously they're still waiting for Intel. So we completely saw that, if you guys follow the channel. And again, I'm not trying to be cocky here. Obviously any prediction I make or any conclusion I come to is complete, can just be complete hearsay and just saying like, oh, I didn't think about this topic or whatever. But it kind of, every semiconductor, in essence, the big majors pretty much relate to one another. So you can kind of see, if you look at, like, say, if you're building a computer, you can kind of follow along, like, okay, if this component's going wrong, what are the next few components that they can upgrade? And Micron just happens to be in the mix of that. So a lot of people are saying that we're now in an oversupplied state of DRAM, but between what actually happened and caused the lower demand for the next couple of quarters in DRAM, assuming, you get past that, and then you have the U.S. kind of banning the Chinese manufacturers from buying U.S. Parts. I don't think it's going to really be as bad as people think it is. And also, I do believe in the long term, especially when we switch over to DDR5, nothing's going to be stopping Micron from, tripling in value, say, during its next cycle. So definitely Micron, look at it as cyclical, look at it as a non-cyclical, and they kind of roughed it out because of all the industries. At the end of the day, Micron is going to have, rough outlook in the short term, but in my opinion, still a very bright long-term view. So that's why I still hold Micron. I'm still waiting for better prices, but Micron, I'm still bullish on the company, and I completely understand that the stock price is probably going to be relatively lackluster, even for the next couple of years. But long-term, I believe the company will do very well. Next, we go to Skyworks. So Skyworks, had a good quarter, but then had really bad guidance, and then a lot of people liked to kill the stock. So the stock is down about 18% from its previous relative high. Not its past. It's down, I think, 40% or so from its all-time high, or maybe 30%. And so it's been getting hammered ever since it gave lower guidance. Apple gave lower guidance on the iPhone. But there are a couple of things to keep in mind if you are either thinking about buying Skyworks, especially at these levels, or if you currently own Skyworks. The big things that I think about right now are the main growth drivers for Skyworks are not expected to really mature until 2020. That is because the majority of big phone manufacturers and big devices aren't really going to be on the 5G network for a while. The 5G, pretty much information blast and Internet of Things, when that takes a hold, is going to be huge, and Skyworks is positioning itself accordingly to really capitalize on it. They have no debt, so they can kind of ride out the rough waters until that happens. But people that were thinking that, okay, 5G is going to be rolling out at the beginning of 2019, that's relative fake 5G. That's kind of like when 4G first came out and everybody was like, oh, it's 4G, but no, it's just slightly faster. It's not really on a new network. That's pretty much happening with 5G right now. So, some people say that 5G is going to be out, in its fullest by next year, and that's just not, we don't have the roadmap for that. Like, you can look at the telecoms. Verizon is still not ready to fully deploy 5G. AT&T isn't ready to fully deploy 5G. It's just not ready for right now. So that's something to keep in mind. That Skyworks is still great for the long term. They don't have debt. You don't have to worry about the company going bankrupt. They pay a good dividend. The dividend's safe. It's only at 25-ish% of their retained earnings. Company is stable. Management's executing well. It's just going to be a rough couple of quarters, and that just happens with tech stocks. They go up really high and they go down really low. That's why it's volatile. That's why some people make a lot of money. That's why some people lose a lot of money. Just things to keep in mind. Then we go to Intel. Intel's relatively stable during the whole thing. I'll show the charts in a little bit. Intel's still trading at a very attractive multiple. Intel doesn't have a lot of debt. Intel's paying a nice dividend. It has a really bright outlook ahead of it. Everything's going relatively well for Intel, and obviously the market, at least the data center market, is waiting for Intel to roll out its new CPUs before it makes their purchase. So Intel's in a nice spot right now. They have already talked about how they're going to be sacrificing a lot of mobile, revenue to focus on data centers. So the fact that it's relatively resistant to this whole iPhone fiasco, even though they were the iPhone CPU used, is very understandable. So Intel still, I think, is a great buy. AMD, on a side note, AMD is also down a lot over the past couple of days. AMD is just a volatile stock at the end of the day. I don't think anything's really changed one way or another for AMD. AMD is just, a lot of people like to trade AMD. I'll say that. So my key takeaways, me personally, just my thoughts on the market. No advice or anything. This is just what I'm thinking at. Next few quarters are going to be extremely slow for tech. We saw this coming. I've talked about it for the past few months now, pretty much since I started the channel again. I've been talking about the tech slowdown that was coming, and it's just pretty much begun. I personally think something like this will continue for a while. I think the volatility it'll probably increase a little bit from here. And again, this type of my explanation is completely speculative. I believe it'll continue a little bit more from here. It might go up in the short term, but I think by the end of, say, next quarter, the majority of, say, the discounting will be priced in. And then I think that, with the exception of us having a recession, it's going to start to return, and then everybody's going to become overly optimistic again, and so on and so forth, as people normally do with tech if you look at all their cycles. Apple, still growing, just not where people want it to be. Like, if you look at their services or any of their other, the wearables, everything else is executing very well except for the iPhones, and the iPhones aren't even not executing that well. It's just not what analysts wanted. So I think the discounting going on in Apple right now is largely due to the market having a shorter time frame. Yes, I do think over the next couple of quarters, Apple's going to be less profitable, but I think Apple is going to become more profitable in the future, and I think it's going to be trading at a higher multiple than it is right now. It's still, what is it? It's trading at a PE of 16 and a forward PE of 13 for the most profitable company in the world, the biggest company in the world, and a dividend growth company over the past few years. I don't get it. I really don't. The company has ballpark $300 billion in cash between investments and cash and inventory. I do not understand exactly where people are going with it, and it's also coincidentally about to bounce on its 200-day moving average, which will be really interesting because if you are long Apple, this might be an amazing buying opportunity, assuming it bounces and corrects off of this moving average. So that'll be something really interesting to look forward to. And so, another thing to really keep in mind is that the overall market is predicting a crash relatively soon. And from my experience and from reading books on market psychology, say Irrational Exuberance, that pretty much focus around what's going on in a market and what causes a recession, at least from a psyche standpoint, not necessarily a fundamental standpoint, is that when you have the big recessions that hurt, it's not because people saw it coming. It is generally because no one saw it coming, except for a very small percentage of the population, and then it blew up, and then the majority of people get hit. So generally you have a recession after maximum optimism, and then you have a bull market after maximum pessimism, which is the nature of markets. So when people are talking more and more about, say, getting a correction, the fact that, okay, this volatility is here to stay, and when newscasters are talking about a recession around the corner, I personally, at least from a psyche standpoint, do not see, say, this mega recession in the short term because too many people are aware of it. And now you can agree with that, you can disagree with that metric as much as you want, but that's kind of the way I'm looking at it. I do think we are due for another, say, 10, 15% added on to this correction. I do think we are due for one. Do not get me wrong. But the fact that everybody's talking about it, I think it would be too easy, say, for that to just spring up. But then on the opposite side, minor corrections or even, say, a minor recession, say anything that's about 20% in total off of its high, a lot of that can be auto-priced in if there just keeps growing overwhelming pessimism for no apparent reason. Now, obviously, there are a lot of metrics to look into with that, but I'm just kind of going off of the past recessions that were covered in the book Irrational Exuberance. Investors can definitely price it in, but the big ones that hurt, say, when the NASDAQ popped, when the housing market collapsed, Black Monday, everything like that, Black Monday, Black Tuesday, all of those big events happened when no one saw it coming. So honestly, the fact that there's still some fear in the market makes me a little bit more at ease. I was more afraid a couple months ago when everybody was like, yes, new all-time highs, tech's going great, all things are pumping on all cylinders. Everything was going great, especially like in January when the whole market went up close to 10% in a month. Those are the scary points. Right now, it's still relatively scary because of the historical high ratios, but right now I'm a little bit better. So what I'm doing, take it for what it is. This is just kind of what I'm thinking about. For Micron, of the stocks that were talked about it, my next buying point is still at $30. I did pick up some at $35 when it dipped. You guys know that I've been covering that along the way. 30 is about book value for Micron, so that'll be the next time I buy into it. And then anytime it, say, goes 10% below book value, I'll probably be adding more shares, slowly, because again, who knows what will happen with Micron. And Micron has at some point traded for very, very low book ratios if you look at historical charts. So maximum pessimism hits Micron. Who knows where the bottom is going to be. But I do think the company, on the long term, with very low debt, deleveraging, and management on track for focusing on long term, I think we're fine, personally. So that's kind of just my thoughts on it. May or may not start a position on Apple. This is mainly based off of, one, the company I think is still running great. I do not like their product because I'm a PC guy, but I know people like their products. I know the company is very profitable. See multiple growth drivers in the future for the company. And if it bounces off the 200-day moving average, this is just a standard correction for the company. So it'll be really interesting to see how that plays. Skyworks and other small semiconductors that are, especially the ones that are related so heavily on Apple, I think they're going to continue to bleed for the next couple of quarters. But then, around 2019, once Intel starts selling more things, and then once other semiconductors really start revamping technology boom, growth, and then other people get more hyped on technology, and then consumers will want a new phone because the people that say bought the 8 series of Samsung, people that bought the 10 series and the 8 series of iPhone, they're going to want to upgrade if they didn't upgrade this cycle. Both the cycles from the iPhone and Samsung side are not selling that well. So after that cycle is generally when people start, revamping their products. So I think about next year we'll re-pick up the, excluding a recession obviously, we'll pick up the technology demand and things will go on just as they were, say, in 2017. Not necessarily like they were in 2017. 2017 was an abnormal year, but you know what I mean. And then things to keep in mind, market is still historically overvalued, so obviously anything can happen, markets as always, but with it being historically overvalued, odds are, in the random events that can happen in the market, I personally believe the majority of them will end badly. Doesn't have to happen. I don't really know how to measure it. If you look at Ray Dalio, Ray Dalio has a way of measuring it, and he thinks that in the next 4 years, we're at 99% ready for a recession. So who knows if that's next year or whatever. Something to just keep in mind. Easy money from tech stocks, I do believe, was made in 2017. I don't think that's happening from here on out. Mainly because when rates go up, pessimism was kind of brought back into the market. Unless you got in on the tech stocks early in very low multiple range, I don't think they're going to be going straight up like they were in 2017. I think we're back to tech being extremely volatile, and that's just what it's going to be. You're only going to make money in tech if you understand what company you're investing in, they have good balance sheets, and you have a stomach. So to quote Peter Lynch, the most important organ in investing is not the brain, it's the stomach. Hedges also remain to be increasingly important, in my personal opinion, and they're still relatively cheap. So if you look at, say, out-of-call options, gold, commodities, things like that, inverse ETFs and things like that, I think they're still relatively cheap. And I think that going further in volatility, they'll only be more and more important, because when you have a spike of pessimism, your hedges will do well. You can sell the hedges and then buy your assets when they're cheaper. In my opinion, that's kind of my goal. I'm also still personally heavily in cash. I was talking about this for the past couple of months, is that I'm really waiting for really good buying opportunities, because historically all of tech is overvalued. I mainly go to value tech, you guys know, off the PEG ratio, and they're pretty high. Obviously companies like, say, Microsoft are growing really well, but Microsoft has, I think, a 3 for its PEG. That means a lot of growth is priced into Microsoft. Microsoft's a pretty big company. It doesn't have the ability to really triple in value over the next 5 years. But that seems to be what people are expecting. So I'm kind of worried about that still. So I'm still heavily in cash. And out-of-money options are becoming more and more attractive to me. I have a couple of them in gold right now. I have a couple of out-of-money call options over the next couple of years, because I think that just as far as market cycles go, generally you eventually go through, say, if you look at the all-weather portfolio from Ray Dalio, you hit a quadrant, and eventually you hit all of the sectors in the quadrant. And for the past 10 years or so, due to a lot of financial engineering, we have hit deflationary periods for a long period of time. I think the type of, and we're still kind of in a deflationary period, I think that we are possibly going to hit a point of inflation, and I think that to make money off of, say, any random event in the market, this is called a black swan, and you can look at, say, Sven Garland's channel for more in-depth things about black swans, or you can actually just read the book Black Swan. You look for events that no one is calling for, that may or may not happen, but if they do happen, you can make a lot of money, and if they don't happen, you only lose, say, a percentage of your portfolio. And so I am expecting that gold and other commodities and metals will be extremely valuable, say, in the next 5 years. And if they're not, oh well, I lost a couple of bucks on a bet. But if they are, I make a lot of money when the rest of my portfolio goes down, and then I can pump that money back into my portfolio. So that's about it for this video. If you guys liked it and you stuck around to the very end, please like and subscribe. It really helps out the channel. If you guys have any other videos that you guys want me to cover, make sure to drop it down in the comment section down below. I try to get back to everybody, and I try to make all the videos that you guys want. I do have Apple, Starbucks, and options coming up. That's next in the video queue. Let me know if you guys have anything else you want. Those are all from subscribers. And if you guys want to touch upon the channel portfolio again or anything else, just let me know. I don't know what you guys want without you telling me. So this is just me guessing until you guys tell me. So thank you guys for watching, and I hope you got some use out of this, and I'll catch you guys in the next video. Peace.